What's going on, everyone? Welcome to another episode of Mortgage Monday. I'll be your host, David Greene, joined by my partner and founder with the One Brokerage, Christian Batchelder. We've got some exciting news for everybody today. Christian has been in his lab, the mad scientist at work, looking for ways that we can bring both new loan products to our customers and cheaper interest rates and costs. If you didn't realize how that worked, this is the right show to be watching. In today's episode, we're going to be unveiling a new loan program we have that is likely to save you quite a bit of money if you are buying a more expensive property, using a jumbo loan, or considering a vacation home. A lot of people don't know about secondary home loans. So in today's show, we're going to teach you about that, as well as how we can save money. So buckle your seatbelt, get yourself strapped in for a new episode of Mortgage Monday. Christian Batchelder, welcome to the show. How are you, my friend?
I'm good. This is going to be a fun episode. As you said, I've been cooking up some devious mortgage tactics here. So I'm excited to share the results of them.
Yes. Now, if Christian seems low energy today, it's because he hasn't been allowed to sleep. I've been putting him to work, much like Ben Stiller in Happy Gilmore, having him work all day long, knitting clothes together. Just kidding. He's been working with numbers, formulas, things that engineers and nerds love. And he's come up with a secret recipe, much like an alchemist has. So, Christian, why don't you share with our audience what this new loan product is, why it's unique to the One Brokerage, and how much money people can actually save if they're in a situation like this and they go with the One Brokerage with their loan?
Absolutely. So first and foremost, this is a combating of what we found to be some of the most expensive loan products on the market. And for those unaware, primarily this is second homes and those who are teetering on a jumbo loan. Okay, so jumbo loans vary depending on which county you're buying in. Some may start at 700,000, some may start at $1 million. It just depends on which county you're in. If you're ever curious, you can just Google high balance conforming loan limits, and you can see when your county would convert from conventional into jumbo. But the goal of what this think tank has been is targeting the most expensive loan products on our clients, and that could be in terms of either interest rate or cost. As you guys know, listeners of the show, you can pivot between those two. You can pay more points to get a lower rate, or a lower rate with less points. Or a higher rate with less points. But there are some loan products across the board that are just more expensive. First and foremost, the second home loan. For those of you unaware, second home loans are the perfect fusion between an investment property and a primary residence. Second home loans mean you as the borrower do intend to occupy the property for a portion of the year, and there are some allowances to rent out the property when you're not there. This is a home product that a lot of people like to get when they purchase a short-term rental. You know, short-term rentals, obviously, you don't have a long-term tenant, and you can rent out the property when you're not occupying it yourself. The downside with second home loans is that the government agencies that regulate these, Fannie Mae and Freddie Mac, most notably, they realized over the last 3 to 5 years, let's call it, that people were buying these homes for exactly what I just mentioned. They're buying them for investment properties, right? Back in the day, 10, 15, 20 years ago, people weren't using these homes to buy Airbnbs. Airbnb wasn't a thing 20 years ago.
Yeah,
right?
It was a vacation home for your family.
Yeah,
basically.
it was, grandma's old lake cabin on the water, right? That's why they were priced much more in line with what you see primary residence pricing, and they were a really good deal, for grandma who wanted her lakeside vacation cabin, right? That she'd go spend, 2 to 3 weeks a year there. It would sit vacant otherwise. And there wasn't really a whole lot of risk to that loan with the lender. Now, once grandma realized that she could make some spicy money renting it on Airbnb, the cause and the reasons for most of the people pursuing this loan product changed. And Fannie Mae saw that with their historical numbers that, these are more similar to rental properties. Now, while 10% down is still achievable, that's the minimum down payment for a second home loan. Obviously, that's half of what most investment products are at, which is 20. Borrowers still love that. They still flock to the 10% down. The downside became Fannie Mae woke up and they realized we're giving investment property style loans for 10% down. So they cranked interest rates on them. And if any of you guys have gotten a second home loan in the last year and a half, you've paid points or you've gotten a really high interest rate. And a lot of times there's a combination of the two. You're paying high points for a high rate to the point where I even got used to telling people that reached out to us as clients, you should plan to track to have this loan as like a 12 or 13% down loan. That's how I was telling people, there's not really an option to not pay points on second home loans. You're still saving a lot on the down payment, but you're almost always going to have points. And that's been true the last year to 2 years. However, as we usually do at the One Brokerage, we thought of an alternative. And this is mainly due to our ability to pivot between lenders, even on the same property. And we've developed kind of a hybrid loan that still enables you to put 10% down, but it changes who funds the loans. And without overwhelming our clients with details, it ultimately leads to you saving between 2 to 3 points on the loan or 1 to 1.5% on the rate for the same product, still 10% down. And you even get the benefit of eliminating PMI.
All right.
So it's a really cool, unique way to look at second home loans, and we'll extend it. It has more uses as well, while keeping the down payment and core concepts of the loan that people like the same.
So let's sum this up. Home loans for second homes or vacation homes used to be much closer in price and rate to a primary residence loan. When lenders realized people were using these properties as vacation rentals, they realized they could charge more, and they did. That meant higher points at closing and higher interest rates, or a combination of the two. That led to this loan product being much less desirable, though it was normally high in demand because you could get 10% down instead of 20% down for a non-primary residence loan. You looked into this and you said, look, this is almost an uncompetitive loan product, but we love our clients being able to put 10% down instead of 20 if they're going to be buying a vacation home. And hey, they're also investors. If they watch us, they probably want to rent this thing out on VRBO or Airbnb and see if they can get that mortgage supplemented for the half of the year that they're not going to be using it or so. And you've created the One Brokerage blend. So we have all of these different lenders that we use that other mortgage providers don't. They typically only have one bank that they lend the funds for. Well, we have how many, Christian? Like somewhere between 50 and 80 or so?
More, probably 150 to 200 would be my shot in the dark guess. We have quite a bit of funders for our loans.
So we look for the funder that's going to be giving the best terms, the best rate, and the best service to our clients. We were able to combine some of these people together to all fund a portion of this, which doesn't really make a difference to the end buyer hardly at all, and create a blended rate that is significantly less. All right, now Christian and I ran the numbers, and we found on a $900,000 property where someone's putting 10% down, so they're going to be borrowing $810,000. Our competition was offering a competitive rate of 8.5%. Some of them were even higher than that. We were able to get our clients at a blended rate to about 7.1% on the same exact loan. Now, Christian, if you don't mind, can you share what that works out to in savings a month on your payment?
Yeah, it's pretty striking. Your payment estimate at that 8.5, and that may even still have points. And granted, that's pricing up today, 2 days before the election, right? But would be about $6,230 a month, $6,230 a month. Our counterpart with our blended financial solution would be about $5,593. That's what, $600, a little bit more than $600 a month savings. That's a 10% reduction on your mortgage. It's a lot of money.
Yeah, that's like $7,000 a year or so. That's a lot of money. So over 3 years, you're talking about $21,000 in savings for the exact same loan. Now, does that also include PMI, or is there an even bigger savings because we are eliminating PMI with this?
It's a good question. Comparing to, and just to tie numbers here, guys, this is comparing a $900,000 purchase, putting 10% down. So you have 10% of 900 is 90. So you have an $810,000 loan. The 6,230 that I said is just your principal and interest, like David shared. You would also have an additional mortgage insurance payment, probably between $100 and $300 a month. So just like David said, with this blended solution, each lender is below 80%. So there's no PMI. And we're actually fusing two lenders together to fund this. They're both at a much lower leverage, though, than the one lender being at 90. And just like David said, it would eliminate PMI and drop your base blended rate. Your savings just on the interest rate is $600 a month. Add another $100 to $300 a month. I mean, you're talking about really substantial savings when you combine both of those together.
Yeah, that's about $800 a month on average difference. Again, everyone, for the exact same loan on the exact same property. Now, here's another way that you could look at it. Let's say you're not as worried about the interest rate and you are more worried about the savings and how much you're paying for the loan. If you chose to get an 8.5% rate with us, just like you could get an 8.5% rate with somebody else, you would get a massive savings in how much you had to pay to get that loan. When we ran the numbers, ours was about $24,000 cheaper. That's right. Your closing costs would be $24,000 less with us than they would be with someone else. Is that right, Chris?
That's correct. And to get that number, it's about 3% of your loan amount, guys. So when you compare these two loan products, if you were to just tie the interest rates somewhat equivalent, like I said when we started, you can choose to save interest rate, which we just went over, 8.5 to a 7.1, or you can choose to keep that same interest rate if we went up to an 8.5, and you can choose to save the points instead. The point savings in this situation was 3 points, and 3% of your loan amount is about $24,000, a huge savings if somebody just wanted to save on the closing cost instead of the $600 to $800 a month savings we're talking about on the rate.
That's right. Now, this is apples to apples. So we're talking about the same amount of money down. We're talking about the same interest rates. You could either save $24,000 or you could have an $800 a month savings using the One Brokerage. And we have this advantage in these cases because we have several different lenders that we can combine into the same loan. This doesn't mean that you're going to have to be writing a whole bunch of checks to a whole bunch of different people. You automate these payments and you can actually pay down one of those loans even faster. If you take that $800 a month savings and you put it towards the second loan, you could get that thing paid off and then your payment comes down even more. Now, this is something that I've been talking about a lot as we move into higher interest rate environments. It starts to make sense in certain cases to pay off your mortgage, to pay down your principal. In the new book I have coming out, Better Than Cash Flow, the 10 ways you make money in real estate, one of those 10 ways is principal reduction. And I detail strategies in the book. This isn't one of them, but I wish that it had been because I could easily have talked about this in that book because it's just a new thing Christian came up with that you can use to build wealth and accelerate how quickly you grow your equity. This is very exciting for us. And it's not something that other people can offer because most lenders don't have the flexibility that we have and they don't put the work in that we do. So Christian, I know you were really excited about this. If people want to reach out to you, if they want to talk to you about it more, if they want to figure out what the next step would be, where can they go?
Yeah, as always, guys, on Instagram, at the One Broker is my handle. DM is the quickest way to get me. You can also always catch me on my email, christian@theonebrokerage.com. We'll link it below in the description of the video so you guys can make sure there's no typos in there.
Make sure you schedule a consultation with Christian. He is a loan whiz. After you talk to him, you will never want to talk to another lender again. You'll tell all your friends about it. You will be the person with the popular, cool friend in high school that you never were in your childhood. Now, Christian, we should also say this is not only for secondary home loans. There's another situation that people run into where loans become very expensive, and that's a jumbo loan. A lot of people think a jumbo loan just means like a mansion loan or something like that. It's not the case. Jumbo loans refer to when your loan balance to buy the property you want to buy is higher than the conforming county loan limits that Fannie Mae and Freddie Mac allow. So in order to get a conventional loan, which has the best financing, you are limited to how much money you can borrow. They're not going to let you borrow $6 million and get a really good rate if the conforming loan limit in your area is $800,000 or $700,000. So you've actually figured out a way to use this same Fusion program that you just talked about for jumbo loans. Can you explain how that would work?
That's correct. And like we said initially in the video, it's not just second home loans. This is a really good place that it can be utilized as well. And the example that I want to provide here is this is not a huge, what I refer to as super jumbo. If you got, $5 million in the bank and, you have a bunch of financial services with Wells Fargo or Chase Bank, they're your best place to go to for a mortgage. They can do things, they can pull strings because you're a significantly preferred client to them. What I'm talking about is the people who are buying their first home in a high value area who may just squeak above that jumbo loan limit, which is, you'd be surprised at the shocking amount of people. If the jumbo loan limit in LA County is around $800,000 and you're buying $1 million property and wanting to put 5 or 10% down, you're a jumbo loan, right? And you may not think of it because in LA, $1 million is like a starter home now, which is insane, but it's true. Your first home loan may be a jumbo loan and you don't have the banking relationship to get a whole bunch of VIP services at Chase yet. Well, that's where this service could be really beneficial. So instead of putting 10% down and getting a jumbo loan, we can fuse these products, bring you down below the jumbo loan limit, and potentially have you put just 5% down. But it's not a 95% first mortgage. We're going to fuse two loan products, get you 95% total financing, but it's not in one shot. What that's going to do is not only allow you to put a less down payment, it's going to eliminate PMI, right? Potentially eliminate it completely. It's also going to drive down your interest rate because these lenders are leveraging at lower loan to values. And that enables you, the biggest benefit with jumbo loans is that it brings you under that jumbo threshold, and we're getting you two conforming loans instead.
Right.
Right.
Yes.
And it allows us to be a little bit more creative. Ultimately, guys, we're not going to go through all the numbers again like we did with the second home loan, but it'll save you on the interest rate. It'll save you potential PMI, and it'll keep you out of jumbo territory where the terms, down payments, and interest rates, once again, unless you're part of that 1% that got a bunch of money, it brings it into the conforming realm, which is more favorable on interest rates and down payment requirements.
Now, one of the things that I really love about how Christian's brain works is it's similar to mine, where we look for inefficiencies to make savings. So let's say I'm walking an investment property and I see this house has a huge chunk of square footage that's being used for nothing good. We could easily put up a wall right here, tap into the plumbing that's right there, and we could create an entire other unit that could bring in $2,000 a month in rent, rather than just having a family room, a living room, and a den that you don't need in the property. That adds value to the property, and it's one of the ways that you make money in real estate. What Christian did here was he looked at these loans and said, these jumbo loans are killing us because when you're only putting 5% down, the rates are astronomically high because the lender thinks that it's high risk. So the only way to get somebody into a jumbo loan that doesn't have a crazy high rate is to put 30% down. That's challenging. What he did was he created a way to keep you out of jumbo territory with high rates and keep you out of that 5% down range and keep you out of PMI by fusing these two loans together. So you're getting conventional rates, you're getting the discounted rate because you're putting less money down to that lender. You're also getting rid of the PMI. When you add all these together, it becomes significant savings. In the example that we went over, it could be between $700 and $900 a month on an $810,000 loan balance. If you bump this thing up to like a $900,000 loan balance, we're talking about $1,000 a month that could be saved and then put towards paying off other debt. And then it starts to snowball. Now you get your second loan that's paid off. Now you have even more money to start saving to paying off other debt or buying new real estate or fixing up the real estate you have. And you're well on your way to creating wealth through real estate, which is one of the things the One Brokerage does differently than other mortgage providers. We think about how to build your wealth, not just how to be slimy salespeople to get your business.
Yeah, that's really good. And I mean, really, even drawing a selfish aspect to this, this is because I'm going to use these loan products, right? So I'm pursuing these because these are, David and I, obviously we're the owners of the One Brokerage, but we're clients as well. I don't like looking, when I go buy a cabin in Tennessee, I look at a 10% down second loan. I don't like those interest rates. I don't like those points I have to pay. So a lot of this is selfishly driven, but it's also driven from a point of looking at the customer's perspective. Man, those rates aren't easy to look at.
Yeah. Man,
that down payment has to be higher. Man, I'm going to have PMI. Man, I have points to close. And it just starts to compound on itself. And it makes the loan, like David said in the very beginning, like an unfavorable product, when in reality, the second home loan is supposed to be a really good option. Like it's supposed to be. That's how it's supposed to be built. And a lot of times with how they've progressed now, it doesn't end up that way. So being able to fuse products like we're pursuing now and getting a really cool aspect in the industry because of our lending connections, because of the amount of funders that we have, because of their willingness to work with us, it enables us to really start to get creative here. And I think it's a really exciting change. I think this is going to provide a new way to pre-approve people who have jumbo loans, a new way to pre-approve second home purchases, and even people who want to pick up Airbnbs where it didn't work at the increased purchase prices, it didn't work at the increased rates with PMI on top. This may be a very welcome change for people to potentially invest in markets that they wouldn't have been able to consider otherwise.
Great point there, Christian, and thank you for that. As a friendly reminder, we do not only do investment property loans. People think that because I'm an investor. We have better service, better loan products, and better rates than almost all of our competition with a primary residence. So please, if you want a family member or a friend or someone that you know, love, and trust to use someone that they can trust, make sure that you send them our information. Let them know we'd like to talk with them. We also do loans in just about every state in the country. So reach out to us if you want to know what a loan would look like. like or what the best loan would be for your specific situation. And lastly, we don't just close deals, we build relationships with clients to help them build wealth over time. So Christian and I spend a lot of time talking to clients and coming up with a plan for how they are going to grow a portfolio, scale their business, have a 3, 5, or 10-year plan to build wealth through real estate, as opposed to just coming in and telling you whatever we need to hear to get the sale and then surprising you at the closing table with fees that were hidden that you didn't know anything about. If you would like to know more about me, you can check out my website, davidgreene24.com. You can also email help@davidgreene24.com to schedule a consultation with me, or you can look me up on social media at davidgreen24. Give me a follow and let me know in the comments what you thought about today's show. And if you want to reach Christian, he is Christian@the1brokerage.com, or he's on Instagram at @the_one_broker. You could also find out about our company, The One Brokerage, at theonebrokerage.com. And lastly, tell us what you thought about today's show and if you're excited to learn how to save more money on real estate with our new Fusion product. Thanks, everybody. We really appreciate your listening. Please share this with someone you know that's into real estate like you. And we will see you next week, as always, on Mortgage Monday.